Good evening, everyone, and thank you so much for joining me for today's coaching class. And today's subject was going to be about hobby versus business, because I know many of you guys are thinking about starting some sort of side hustle, or maybe you already have a side hustle, and you are claiming a lot of expenses on your tax returns. Whenever a startup business claims a lot of expenses on their tax return, sometimes they fall into a trap and where somebody act like a tax strategist, or somebody try to act like, hey, I know more than your CPA, and they try to tell you to do things a little bit differently than the way we do it in tax business. So I'm going to talk about some of those traps, how people end up paying $5,000, $10,000 in some sort of consultation session, and they claim all kind of expenses thinking that's going to help them reduce their taxes. But exact opposite happens. They get audited, and then they end up paying a lot of interest and penalties, and obviously then going forward they have to fix their tax return anyway, so whatever money they pay to that consultant, it goes to waste as well. So a good tax consultant doesn't really just care about a good tax strategy. He also cares about making sure that you stay out of trouble. So many times I see tax plans where people, talk to somebody who has charged them 15, $20,000. And I look at that tax plan and I'm like, I'm not going to recommend implementing 75% of it because it's all garbage. Makes no sense. It's waste of money. And when they call the tax specialist back and ask for their money back, they get nothing in return. So you're looking for somebody who is not just able to tell you the tax strategies, but also able to help you implement those. That means they're also signing your tax return. And I think that's where a lot of things goes wrong. So today I'm going to share some of these traps that I see when I'm looking at people's tax return and how a lot of people get into trouble. So we're going to talk about what is a business, what is a hobby, how does the taxation of income and expenses work on hobby versus on a business. Why do people even do all this crazy stuff? And that has to do with something what we call net operating losses, NOLs. So we'll talk a little bit about that. We'll also talk about how does IRS figure out whether you're a business or a hobby, because oftentimes we there's like a fine line between those two. People get confused, and I see all kind of answers that people give. Oh, this is a hobby because of ABC. But I'm going to get into nitty gritty details as to what does IRS specify as a business, because they don't technically give you an exact definition, but they leave you a lot of clues. And using those clues, IRS determines whether you're a business or a hobby. And then we'll talk about some of the limitations around claiming those expenses, and we'll run through some examples as well. So that's what we're going to do in today's class. And at the end of the class, I'm going to take your questions as well. But I know some of you guys are my existing clients, so you probably know a lot of this. So this will be a good refresher. Some of you guys are brand new. You're just judging me right now. You're trying to figure out what kind of value I can bring to you. So I do a lot of training classes for my clients, and not just about taxes. We talk about financial markets, we talk about real estate markets, we talk about how to build wealth in this country and stay out of trouble. So I will never teach you to do something wrong. I would not teach you to do things illegally. I'm not going to give you an investment advice. I'm not going to tell you, hey, buy this or buy that. My job here is to educate you. So that's what I do. And you can see that in this class today as well. So once again, if somebody doesn't know who I am, my name is Deepak. I'm a tax code advisor. I help people with tax strategies. I help them file their taxes. That's what I do for a living. So let's start with a business. What is a business? What would you call a business, right? There are a lot of ways we can define a business. For example, some people might say, I'm an LLC, so I'm a business. That's a common answer I get. Well, just because you're an LLC does not mean you are a business. Sometimes people say, oh, I'm an S Corp. That's why I'm a business. Again, wrong answer. Just because you're an S Corp does not make you a business. That is simply an entity. That is how you operate your business. Business means, from an IRS point of view, that you're making money, because when you make money, you pay taxes. That's what IRS wants you to do. And if you're paying them taxes, you're making money, then they give you some special treatment. For example, if I make $1 million, I don't pay tax on $1 million, right? I pay tax on my net profit. That means after paying all my expenses, that means I can pay for my office, I can pay for my employees, I can pay for my computers, I can pay for my software, I can travel for my business conferences, I can go meet with my clients, so I can write off my car. So there are like tons of deductions I can take, and after all those deductions, whatever money is left over, that's what I pay tax on. That's how our economy works. Our government wants to encourage us to spend money. And that's why I say, look, if you spend, we're not going to charge you tax. Can you imagine? Let's say some of you guys are W 2 employees right now. What if your employer says that, hey, look, any money that you spend, we're not going to charge you tax on it. But anything that you keep in your bank account, we are going to charge you tax on it. What do you think how the behavior of all the employees would change in this country? Do you see what I'm trying to say here? Right? Same thing happens for business owners. The government is giving them an incentive to go out there and spend money. And when they spend money, what happens? That money goes into other businesses. What do other businesses do? They buy equipment, they hire employees, and the cycle goes on and on and on. That means from one business, that money moves on to the second, to the third, to the fourth, to the five, and that's how our economy grows. So it's a great incentive to be to have a business owner. But three things I want you to remember here. Number one, you got to have an intent to make profit. If you're getting into something that is not going to make money, that you're doing this only to save taxes, then you're making a mistake. Number two, it doesn't matter what kind of entity you are. You could be a sole prop, you could be a partnership, you could be C corp, S corp, doesn't matter. As long as you have an intent to make a profit, your business, how you do that business is not so important. Lastly, you can deduct all of your expenses, and if you have a net loss, then you can even write it off against other income. That's the beauty of owning a business. On the other hand, if we compare that to a hobby does not have an intention to make profit. Hobby is recreational in nature. It's for enjoyment. It's something you like to do in your spare time. So I put some examples here like painting, fishing, photography, etc. Please, if you are in one of those professions, I'm not saying that you are a hobby. Okay, so don't read it wrong. You could very well be a business. I'm just saying most people in these professions are typically operating it like a hobby. They're not. If you're imagine if you're painting, maybe you're an artist, and you make $5,000-10,000 a year. Is that really a business or is that really a hobby, right? So that's where all these fine lines. Like if you're making tons of money, no problem. You're certainly a business. Problem happens when you're not making good amount of money. And I'll show you some examples of some of the very basic mistakes people make that gets them in trouble. The reason why we need to understand the difference between hobby and business is because hobby revenue is taxable, but expenses, those deductions that I talk about, remember I said that you can even have more expenses than income if you are a business owner, and you can take those expenses and write them off against your other income, like your W 2 income, your real estate income, etc. And there are more details, and I'm going to get into all those. But the main point I'm trying to make here is you cannot do that with your hobby expenses. That's where it gets nasty. Hobby expenses are limited. You can only write off up to your hobby income. So if you have a $5,000 in income, you have $5,000 in expenses, that's all you can write off. Anything beyond that, nothing. There's nothing you can do. Hobby cannot generate a deductible net loss. That means you cannot carry them forward. There's nothing you can do on. They're completely lost. So we want to make sure whatever activity that you're doing does not get classified as a hobby, because I see it way too often. Businesses. Let's go back to business for a second. Okay. Business expenses. Can you write off everything? Like for example, if I decide to go tomorrow to Switzerland, can I write off that expense? Well, I mean, depends. Why am I going to Switzerland? Am I going there to help out a client? Maybe it's $1 million business and they need to, my travel is going to generate a good amount of income for me. Then maybe that's reasonable. But if I'm just going there to go doing some sightseeing, well, that is not an ordinary, necessary, or reasonable business expense. So those are the three categories that IRS looks at. So every single expense has to meet those three criteria. And sometimes, just like a difference between hobby and a business can be a little bit blurry, so is the definition of expenses as well. So, for example, as long as I meet those three criterias and I had $1 million of expenses and a $500,000 income, that means I'm going to generate a $5,000 of net operating loss. Well, guess what? When that happens, I can deduct that operating loss against my other income. So maybe my wife is working for some company, and maybe I have a part-time job, or maybe I have some real estate income or something like that. Well, I'm able to write it off against other income sources. That's the beauty of these NOLs. And once again, that's the benefit that you lose out if your activity is classified as a hobby. Now, you know, um, most people will misclassify their activity. When they file their tax return, they're going to say, I'm a business. So I'm not saying what you classify it as. I'm talking about how does IRS looks at it. Are they going to see you as a business, or they're going to see you as a hobby? Like I said, the main benefit or main reason, I would say, not even really a benefit, technically speaking, because obviously, certainly, you don't want to create these operating losses. You want to create profit. You want to be, the idea here is to make money and pay taxes. But certainly, in some cases, you're going to end up with NOLs. For example, you probably hear this in news. A lot of companies are moving to Texas these days. They're buying big land. They're putting up factories. You might even see it in companies, right? When you go read financial statements of some of these public companies, and you'll see they're not making any money. They're producing net losses. For example, I was looking at I think I was looking at Snapchat, if I remember correctly. Let me see if I can pull that up here for a second. Give me 1 minute. Yeah, so I'm looking at this. This is something I posted earlier. I was looking at Pinterest, not Snapchat, sorry, Pinterest. So Pinterest in 2018 had a negative $63 million of net income. 2019, again, a negative $1.4 billion. 2020, negative $128 million. 21, they had 361 million. 22, they had negative 96 million. 23, negative 36 million. In 2024, positive of $1.98 billion. That means from 2018 to 2020, 3 years, negative. 21, positive. 22, 23, negative. And 24, again, positive $1.9 billion. So you see, now in 2024, they can take back all of these losses that they had, that 63 million, 1.4 billion, 128 million, 96 million, all of those losses, they can take it against this income that they had in 2024. Why? Because these net operating losses carry forward. So they had no income. So obviously they didn't have to pay taxes. But now that they have income, guess what? They don't have to pay tax on a lot of that income, because they're able to take those carry forward losses from earlier. Why? Because they're treated as a business. If they were treated as a hobby, and let's say it's similar to, let's imagine Pinterest can be classified as a hobby. They certainly are not, but if they could be, then they can operate 3 years, 4 years at losses, and fifth year, let's say they blow up just like they did, almost $2 billion in profit. Guess what? All of that becomes taxable, because they lose out on this critical benefit they had many years. So imagine how many of you guys have a startup, how many of you guys are starting a retail business, maybe into real estate business or some other business. If you get misclassified as a hobby, you lose out on this very critical benefit known as NOL. And it is not common or not uncommon that many startup businesses might not have profit. They might actually have losses, and that is all right. But we just got to make sure you do not get categorized as a hobby. So how does that NOL work? Let's talk a little bit about that, so you better understand it, right? So um, net operating losses, like I said, your income, your expenses, whatever you have left over. If those expenses are more than your income, then you have net operating losses. They can carry forward for as long as you want. Back in the day, it used to be only 20 years, but not anymore. Now they can go back 30, 40 years, but certainly most people would not need that. Hopefully they are able to recover, all of those losses in 2, 3 years. So, um, the key thing to remember here is, if you have net operating losses, because I mean, I gave you a Pinterest example, but that's a large company, public company. Most of us are small business owners. So let's say you have an operating loss of $1 million. Okay. Um, and you had that operating loss of $1 million. and you have a W-2 income, and that W-2 income is, let's say, $1 million. So can you take that entire $1 million and write off that $1 million income? No. What you can do is that loss you can apply is up to 80% of that income. So 80% of $1 million is 800,000. So you had $1 million of net operating loss. So 800,000 we can apply, and the other 200,000 will carry forward to the next year. So let's say next year again you have $1 million income. Now I'm not talking about your business income. I'm talking about some other income, maybe from W-2 or something else like that, and you can apply that $200,000 to that income. So that's how those operating losses work. But there are some limitations which are important for us to understand. So let's take a look at those. For example, okay, first thing, just to clarify, if you have operating losses, you can write it off against other active income. Like maybe you have other business income, maybe you have some capital gain income, maybe you have some rental income, dividend incomes. There are some limitations. I'll go into those, but a lot of these other income that you might have coming in from other sources, you're able to write them again. So this is a wonderful way for reducing taxes. So for example, if I want to, let's just say if I have a $500,000 income and I'm going to end up paying, let's say, $200,000 in taxes, and I don't want to do that. One of the ways to get to deal with that problem would be that I get engaged in some sort of business that can generate that net operating loss for me. Okay. Obviously, I don't want to. So once again, to clarify, it may generate a loss. However, I still have an intent to a business with it. I'll give you an example. Let's say maybe I buy a big residential apartment complex for $5 million, and that can generate some losses for me in the amount of, let's say, $500,000 or more. So now I have $500,000 of loss from on paper. I have a $500,000 of income. I'm able to write it off against that, right? But the key limitation here is that 80% of taxable income. That's what you want to know here. So it doesn't write off, but 80% is pretty good. I think most people will be happy with that. So here are some of the limitations that we run into. One of the limitation is passive activity loss. So meaning, I gave you an example of real estate for a purpose, because what if your real estate was something where you're not involved. You're letting third party manage it. You're not really running that business at all. In that case, that would be considered as a passive activity, and then passive activity losses limitation will apply. That means you can only write off up to $3,000, and anything after that will carry forward in future. But if you are, I purposely pick an example of apartment building that more than likely I'm operating myself. I'm actively participating in that business. If that's the case, guess what? Whatever losses I create, I'm able to write off against my regular W-2 income. So that's the beauty of it. But remember, so there are two limitations I talked about. I talked about the 80% of your income. That's one limitation. Second limitation is you have to actively participate in it. Okay, that's number two. Number three, sometimes people create these losses by taking non-recourse loan. That means you don't have any risk. And if that's the case, then IRS says, okay, if you're not taking a risk, we're not going to let you take these net operating losses. We're only going to let you take them up to the amount you have at risk. If you don't have the amount at risk, then we would not let you claim that. So you got to make sure that you have that. Another limitation here is qualified business income. Now, this is a subject on its own, so I'm not going to get into detail, but I did do a video a few days ago. You can go back and watch it if you want to better understand it. But in simple words, what QBI means is that you get 20% discount on your taxes. Look, if I have a qualified income, let's just say for $400,000, and that's my net income, then 20% of it is tax free. So I get that. But let's say if I have some net operating losses from some other business. So I'm in business A that does have a $400,000 in income. I have business B that has $400,000 of net operating loss. I want to use that loss to write off against my other income from other business. Am I able to do that? Yeah, certainly I can do that. No problem there. But the problem here is this business would have qualified for 20% discount, but I lose that discount now because I'm using my NOLs against that. So that's sometimes that does not work out in our favor. So as a reminder, first of all, we have to have that 80% limitation. Number two, we need to make sure that we are actively participating in an activity. It's not a passive activity. Number three, we want to make sure that we have we're not dealing with a non-recourse loan, so that's important. So those are some of the things that you want to watch out uh, with the NOLs. Some of the strategies that I share with people all the time is when you run into these kind of problems, we play around and see how we can get around this 80% limitation. Sometimes we will spread expenses across years to avoid creating excessive losses in one year. That we'll say, okay, we're going to reduce our expenses. We'll rather take them next year than this year. Sometimes we look at the startup cost. Maybe we don't want to take them as an expense. Maybe we capitalize or amortize them. So sometimes that works out. If people are involved in passive activity, we look for ways to convert them into an active activity. So there are ways to go around that. But main point I'm trying to convey here is that having a business gives us such a big opportunity to save on taxes. It's just amazing. That's why I keep looking out for new opportunities to set up a business, whether it's through, selling something on Amazon, whether something doing out of my garage, from my home, maybe into real estate. Every day I'm looking out for opportunities. Okay. But I don't get the same benefit with my hobby. With hobby expenses, I am limited to my hobby income only. There is no concept of this net operating losses is when it comes down to hobby. Any loss I create as a hobby is completely lost forever. So imagine you have a business and it generated maybe four, $500,000 of losses. And if I'm treated as a hobby, guess what? It's gone. Now, could I have avoided that? Yes. I could have. I could have structured that business a little bit differently. And if I would have structured it differently, then most likely I was able to write off those hobby losses. I was able to take on those net operating losses. Just because I structure them wrong, I get into trouble. So it's so critical to go through a proper consultation to determine whether you have a proper business. Number two, what kind of income you will generate, how long would it take, how should we structure this business. People underestimate it all the time. So I think watching this video kind of starting to give you a picture as to how important it is to go through those kind of consultations. Okay, so this is a common one I hear from people when they talk about what is hobby versus what is business. Standard education that you will get from YouTube or wherever else you're searching would be that, hey, look, if you make profit in 3 out of 5 years, you're good to go. That's a standard answer that you're going to hear. And if you ask me, generally speaking, in the elevator, most likely that's the answer I'm going to give you as well. However, that is such an incomplete answer. So I'm going to reveal some major secrets to you today that's going to help you understand it so much better. Okay. So, for example, let's say you show a profit for small amount in first 3 years of your business. Okay. And then other years you show large losses. Now, technically speaking, 3 out of 5 years, that makes sense. Hey, you made money in 3 years and 2 years you show major losses. It looks good on paper according to that definition, but IRS most likely is going to challenge you and they are most likely going to classify you as an hobby. That's why it's important to look at factors beyond income. This is what you're not going to get from most tax professionals. Even most people who are giving you coaching training, they don't talk about this stuff. Why? Because this takes time. This takes that advisory session where we are having that discussion with the client and we are trying to better understand what they are doing. And by the way, what I'm sharing with you today in today's class, this is what you get as the advisory client. This is the kind of information when we talk about anything, this is how in depth we look at it. So to better understand what exactly we are doing, why are we doing, so that way when we are documenting everything, it makes sense. So what is a business? Well, first of all, business is going to operate like a business, right? That means they're going to have proper books, they will have proper records, they're going to have a proper operating agreement, they're going to have proper business plan, they're going to have proper marketing plan, they're going to proper calendar, they're going to have proper actions they're taking, they're going to have proper business licenses. And the person operating a business, that person most likely is going to be qualified, because let's say if I want to get into a construction business, I don't know nothing about construction. Why would I do that, right? If I want to get into construction, what do I need? I need a partner who knows construction, or I will hire an employee who knows construction. So question is, what is your relevant education? What is your training? You're a doctor and you're trying to do an engineer job. Oh, something is wrong there. So I get a little bit worried, you know. What kind of research have you done in that industry? What kind of business plan have you made? How much time are you spending on that? Who is managing your daily operations? Are you properly involved in it? What are your projections? What does your profit and loss looks like? Or what kind of trends you have? How are you going to make profit? How does your income compares to other people in your peers? Who are your competition? Is your business speculative in nature, or is it you have some sort of plan to make it profitable? What kind of investment did you make? Where did that money go? What kind of loan did you take? Who did you take the loan from? Where does your income come from? Do you depend on this business, or the income come from somewhere else? How much time are you spending in the other business? Is this business have something to do with making profit, or is it for your personal enjoyment? Who are your customers? Are you primarily selling it to your sisters and brothers and your family members, or do you have a third party customer? How are you marketing to them? Look, as a business owner, uh, you know activities that you do are quite clear, right? If And that's why I went to in so much detail about this stuff, because if it's a hobby, most likely you're not doing any of this stuff, right? You're just simply doing it either because of tax benefit, or you're doing it because you just enjoy, you just like doing that. All right, so let's talk a little bit about hobby expense. I think you're very clear on why having a proper business is important. I think you understand how net operating losses can offset your other W 2 income, which obviously many of you guys will love to do. Now, let's talk about the limitation of hobby expense. That means if whatever activity you're doing, if it gets classified as a hobby expense, what happens? Okay. So what happens is, oftentimes people assume that they have a business or a hobby, right? They don't know whether that's a business or a hobby or not. So we're going to leave that out for a second. But they think that they have an income, so whatever the income is, and then they have this lump sum expense of all the things that they hear about online, or some tax guru who's trying to teach you that. They might say, hey, you can write off home office, you can write off your car, you can write off depreciation on your property, you can amortize this expense, that expense, all kind of stuff here, right? And you add all that, and sometimes they even, and I have seen them, by the way, they sell coaching sessions for tens of thousands of dollars. I have seen people attended them, and then they come to me and they go like, hey, I got this tax plan. I'm like, yeah, you got it, but it's worthless. This is not how it works. This is complete garbage. The way you deduct expenses come in an order. So I'm going to walk you through that order today so you better understand it. So for example, if I have a hobby of making paintings in my home, my first expense is cost of goods. For example, maybe I have to buy some paints, I have to buy some frames, like direct cost for generating that painting. I probably got some paper, I got some stand, some lights, some colors, some brushes, all that kind of stuff. That is my cost of goods sold. So obviously you're not going to spend more money on cost of goods sold than your revenue. Hopefully not, if you're a good business owner. But sometimes you might. I've seen that. Sometimes people go like, yeah, I sold one painting for $5,000. Okay. And how much did you spend on supplies? Oh, I had to redraw that painting 20 times. Why? Because I'm learning. I'm new at it. So what's your expense like? Oh, I had a $50,000 expense last year. Guess what, buddy? All of that extra expense you have, we cannot write it off, right? It's limited to the income you had. So if you have a $5,000 income, that's the only expense I can write off. We're done. Okay. Sometimes they will say, okay, what about, like my property taxes and mortgage interest? Well, why do you want to write that off? Well, because all these paintings are sitting at my home. So they're taking space. Well, first of all, your property taxes, your mortgage interest, you should be able to itemize it to begin with. But I understand sometimes you're not able to do that because you are taking standard deduction. You don't have any of the expenses. So I get that. Well, guess what? If you are have more expenses than your income, then you're not able to take expenses against that property taxes and mortgage. But let's play along, and we will assume that your cost of goods sold on a $5,000 painting that you sold was only $1,000. So you still have a $4,000 net profit. Okay, so now we're talking. So now we can, what we can do is we can take a look at your property, and we can say, okay, what percentage of that is being used for business, and based on that we can calculate your expense. And then once that expense is added, and if you have exceeded the total revenue for the year, once again you can't deduct anything else. For example, maybe you want to deduct your utilities, maybe your gardening costs, maybe your home, maybe you have somebody come doing the cleaning for that space. You cannot write any of those expenses because you have already exceeded your revenue. Then sometimes I'll see people even talking about taking depreciation on the property or amortization of major expenses and all that. All of those, they are all suspended till 2025. So some of you guys like, oh, good. That means I can take them in 2026. Most likely not. Most likely Trump 2.0, because Trump is the one who did that. He increased the standard deduction and suspended all these other stuff that we used to be able to do that before. Most likely he's going to get rid of them and make this structure permanent as well. So my point is, if you are in such a business, then we need to really think about how are we going to structure it and how are we going to expense it. Okay, so key thing to remember is between 2018 to 2025, hobby related deductions are not allowed. Property taxes and mortgage interest may be deductible because they're deductible anyway, right? You are the person, you can deduct them, but like I say, it's a maybe. And again, it depends upon how much income you have, because you cannot have those net operating losses at all. So, so I ran some example, but I think you get the main point here. So I don't think we need to really go into the detail. The main point is, these are the common expenses that I see when people are classified as a hobby. Again, they think they're a business, but they're really classified. They're trying to write off home office. Trying to write off their car, their utilities. They're trying to depreciate their home studio. They're trying to amortize these big equipments they purchase for their business. They're trying to take some maintenance costs, utilities, all kind of stuff, because somebody somewhere told them that they are able to do that. Unfortunately, all of that gets suspended if you get qualified as a hobby. That's why I took my time to explain to you why it is critical to be classified as a business. And I went through so many criteria that IRS looks at to identify you as a business. What I recommend to my clients is, when we are having consultation, to set up a business, one part is we talk about how should we structure it. Should it be an LLC, S corp, C corp, sole proprietorship, partnership, and how should it the overall structure look like? But more importantly, we also talk about to make sure that you don't accidentally get classified as a hobby and get stuck with a big tax bill, because obviously you wouldn't know that you're a hobby and you're going to claim yourself as a business, and IRS will look at it, and then 3 years 4 years down the road they might knock on your door and say, you claim these 200 $300,000 expenses over the last 3 4 years. We don't agree with them. We want you to add them back to your income and pay taxes on it, and that becomes very painful. So I don't I certainly don't want my clients to get into trouble. That's why it's important to understand it properly, do proper record keeping, and making sure you're making money. So important if you want to take advantage of everything tax code allows us to do. So that's all I have for today. I hope you found it very, very helpful. I'm going to take your questions. I know I see a lot of hands being raised already. So certainly I'm going to go through one by one. But once again, those of you guys who are new, or maybe you're watching it on some other channel, most likely I'm going to post it on YouTube for other people, because I think they're going to find it very helpful as well. If you don't know who I am, my name is Deepak. I'm a tax code advisor. So if you need it, if you're thinking about starting a business, or maybe you're living in a different country, or and you want to start a business here in the US, or maybe you're a US citizen and you have moved on to a different country and you want to take care of your compliance, I'm your guy. Reach out to me via taxcodeadvisors.com. You can set up a free discovery call if you want to get to know me better. You will get, if you're my client, you will certainly get access to a lot of stuff, right? You get access to coaching classes where I talk about taxes. You get access to financial coaching classes where I talk about, what kind of things are happening in the market. I talk about what things are happening in real estate. So I spend a lot of time providing tons of value in the form of coaching to my clients beyond personal consultation as well. So I try my best to deliver exceptional value to you guys. So once again, thank you so much for joining today's class. I'll stop the recording here so that way you're welcome to ask any question you would like to ask. Okay. So let's take a 2-minute break and then we'll get started.